Lesson 3: Accounting Assumptions. Accountants make some assumptions while preparing financial statements. According to the accounting rules, these assumptions are assumed to have happened in all financial statements unless otherwise stated explicitly that these assumptions have not been followed. So, as a reader of financial statements, it is very important for you to understand what these assumptions are and how these impact financial statements. The first assumption is called the going concern assumption. In simple words, the going concern assumption assumes that unless proved contrary, accountants can assume that the business entity will have an infinite life. This means that external users of financial statements like you can safely assume that an entity is a going concern and therefore is not going to file any bankruptcy or close down its operations in the near future. So in other words, going concern assumption states that the entity will continue to exist and will continue to operate in the near futures unless otherwise stated. Why is going concern important? Let us look at an example. Let's take an example of a small pizza shop. It has assets in the form of building, furniture and kitchen equipment worth $10,000, $2,000 and $8,000 respectively. So under normal conditions, under the going concern assumption, the assets or the things that the business owns is $20,000. Now let's assume that there is some issue with the business. Let's assume that the promoter wants to close down the business and go back to his hometown. So he's in a hurry and therefore he wants to sell off all his assets. So the buildings will not fetch what they're actually worth. Since he's in a hurry, he might possibly want to sell it off at a slightly lower price. So let's assume that the buildings will fetch $7,000, furniture will fetch $1,000, kitchen equipment will fetch $3,000 and so on. So when the entity is not a going concern, it fetches much less than what it is actually supposed to fetch. And it is for this reason that the going concern assumption is very important. So whenever you're reading a balance sheet, go through the attached notes and accounts. Very important. Go through the attached notes and account and see if the accountant or the auditor has made any comment relating to the going concern assumption not being valid. If it is not valid, or if the going concern assumption is not valid, then it's a serious cause of concern. It means that the business is likely to close down in the future. Very important. So look at this example. Now this is a photo that I found on the internet. I think the shop owner is trying to sell off all his goods and close down his business. That is why he's giving a whopping 70% discount on all items. So these are typically the conditions where going concern assumption may not be valid. Okay. The second assumption that accountants presume to make is called the consistency assumption. The consistency assumption states that a business must choose a single method of accounting and use it consistently over a period of time. Now, as you might be aware, accounting is sort of, in a way, it's a slightly complicated subject because there are a lot of rules, a lot of debits, credits, principles, practices that accountants follow. And because there are so many practices that are in existence, there is a possibility that accountants might change the practice being followed from one period to another. So the consistency assumption states that accountants should follow the same practice or policy consistently over a period of time. And in case there is a change in the accounting assumptions or in the accounting policies, they need to be clearly stated. So now let's look at a very simple example of how the inventory practices can affect the financial statements of a company. Let's assume that you own a clothing store and you have t-shirts which are selling at a price of $10. Let's assume that you have 3 t-shirts which you purchased at $4, $6 and $8 from the vendor. So now assume that you're selling the first t-shirt to the customer. The selling price or the revenue that you earn from the sale is $10, right? Because that is the selling price of the t-shirt. Since you're selling the first shirt, which you have identified, the cost of the goods sold is $4 because this particular shirt was bought for $4. and therefore you made a profit of $6. This method of accounting for inventory based on specific items which are easily identifiable is called the specific identification method. Now, though I've given you the example of a clothing shop, generally the specific identification method is used in shops where the inventory is easily identifiable. For example, shops which sell antique pieces, or shops which sell gift articles which are unique in nature, where no two articles have the same price, So the specific identification method is one method of accounting for inventory. Now let's look at another method. Assume that the accountant, instead of using the specific identification method, takes the average cost per shirt. Since this example, we have only 3 shirts in the store, but usually that is not the case. Whenever you go or walk into a store or any retail shop, there are thousands of items of inventory, and it's practically impossible for the accountants to keep track of each and every item of inventory. So what accountants usually do is they adopt another method where they take the average cost per item, if they are similar in nature, and use that as the cost of goods sold instead of using the specific cost method. So in this case, look at the cost of goods sold. The revenue will still remain the same because that is the selling price, but the cost of goods sold will change to $6 because that is the average cost, and therefore the profit will change to $4. 10 minus 6, 4. This method of accounting for inventory is called the weighted average cost method. So what I've given you is just one example of a accounting policy change which could impact the profit of a business. So the consistency assumption states that accountants should follow the same practices consistently and apply it over different periods. And in case there is any change, this has to be clearly disclosed in the notes to accounts. If you open any annual report of top companies, you will find financial statements, which is balance sheet, P&L, cash flow. We'll look into them. But apart from these, you'll also find a small notes and accounting policies which are mandatory to be annexed along with the the financial statements. So in those notes to accounts, these things such as going concern, consistency, etc. are stated. So that is very, very important. I suggest that if you get a chance to have a look at the annual report of any top company like Microsoft or Apple or Amazon, please go through the notes of accounts along with the financial statements. Reading the financial statements alone without reading these notes does not make sense. So this is the second assumption. Let's go to the third assumption. The third assumption, and according to me the most important assumption of all these 3 assumptions, is the accrual assumption. The accrual assumption states that revenues, costs and expenses are accounted for as and when they are incurred and not when the cash is actually received or paid. Let me give you an example. Assume that I work for a business and my monthly salary is paid on the 7th of the subsequent month. So the January salary is paid on February 7th, the February salary is paid on March 7th, and so on. So as per the accrual assumption, the salary is accounted as cost in the month in which it is due and not on the month in which it is actually paid. So my January salary will be accounted as an expense in January itself, though it's paid in February. Similarly, my salary for February will be accounted as an expense in February itself instead of March when it is actually paid. The same holds good for revenue also. So assume that you sell some goods to your customers and you agree with your customer that they can pay you after 45 days. As per the accrual assumption, your revenue should be accounted on the date of the sale and not on the date on which cash is actually collected. Let's look at some examples and we'll go through this slowly. So like I said, revenues are recorded when goods are shipped or the sales are made and not when the cash is received, and expenses are recorded as and when they are incurred and not when the actual payment is made. Let's go back to this pizza shop example. Assume that the pizza shop has a corporate customer close by and it supplies pizzas on every Wednesday to these corporate offices. It agrees with the office that the cash payment can be made on the 15th of the subsequent month. So it's going to supply 4 times in a month on Wednesdays, and the cash will be paid by the customer on the 15th of the subsequent month. Under the accrual assumption, the sale is accounted on the day on which it is made and not when the cash is actually received. This is very, very important because this is one of the most important assumptions of financial statements. So income is accounted on the date of sale and not on the date of receipt of cash. Summary. So we've seen 3 accounting assumptions. The first one is the going concern, where a business is assumed to remain in existence in the near future unless the contrary is proven true and clearly stated in the notes. Second assumption is the consistency assumption, where accountants are assumed to have followed consistent accounting practices from one period to another unless otherwise stated. The third assumption is the accrual assumption, where revenues and costs are incurred on the date of the transaction and not when they are actually paid or received.